Hi, everyone, and welcome to Neolin FX Weekly Outlook webinar. I'm Lelo, and I'll be guiding you through this week's potential market moving events, trends, key microeconomics developments, and actionable trading setups. Visit our website, Neolin FX, and sign up in just few steps and receive unmatched trading conditions with minimal spread, and you'll be met with a dedicated support team. Before everything or before you trade, please read our disclaimer. The information provided in this webinars is for educational purposes only and should not be considered investment advice or recommendation. The content does not take into account individual financial circumstances, objectives, or risk tolerance. We strongly encourage seeking guidance from an independent financial advisor before making any investment decisions. Neolin is not responsible for any losses incurred based on the information presented in this webinar. So today we'll be covering some of the major assets: BTC dollar, euro dollar, gold, S&P 500, and WTI oil, and explore how you can plan your trades with clarity and confidence. So let's dive straight into the fundamentals driving the sentiments. As we have seen, markets are under pressure as geopolitical tensions, growing fear of tariffs wars dominate the sentiments. S&P index, let us go to it. S&P index is down by 1.57 today, and the market has been down for 4 consecutive trading days with a total loss of 688.2 points, marking a 12.14% decline. It is the largest 4 days percentage drop since March 16, 2020, and the longest losing streak since February 25, 2025. And what triggers this volatility? It's the renewed threat of additional tariffs, especially between US and China. It's the heightened geopolitical uncertainties across the global hotspots. I think the last one will be mostly the risk of sentiments driving investors out of equities into safer havens. And it's resulting into equities are sliding. Let's go to the chart of S&P. The equities is sliding. As you can see, the S&P, there's volatility that is spiking. The safe havens assets like gold and bonds are gaining traction, and traders are being more cautious, preferring short-term setups and defensive play when it comes to the market. So we're in a very high reactive environment, especially with rapid price swings, limited flow through until there's a clear or there's clarity on policies or geopolitical resolution. And then also manage your risk and stay agile. So let us move on to what we have for the week. There was not much noise on Monday and Tuesday. It's just that we opened with a risk off sentiment during Sunday to Monday. But starting from Wednesday, the New Zealand Reserve Bank has actually cut their rate decision. In February, it was 50 basis points. Now it is lowered to 25 basis point, which is 3.50. So there was little or less impact than expected on the NZD pairs. So there wasn't much of the volatility on that one. Also on Wednesday later, today, you will see we have the US Fed meeting. So we should be watching for hints on the future, rate hikes or cuts. So if we have a hawkish outlook, this could lift US dollar, but a bearish could boost metals and indices. For those who are specifically trading metals and indices, you might be taking a look closer look at that, at those news. And then on Thursday, let's just move on. Thursday, we have US CPI year on year. The previous, yes, the previous data was, was 2.8% in February. And right now, the focus is 2.5%. So if the inflation cools faster than expected, we can expect that the DXY, the dollar, would weaken, which will cause the gold and Euro USD to be bullish. Same day on Thursday, we have US jobless claims. Let's move into it. We have the initial jobless claims. And previous data, as you can see, was 219, and the focus is 223. So higher claims will cause the slowing in the job market, and that might impact the Fed's expectation to be dovish. Lastly, last trading day of the week, we will have the UK GDP month on month. In January, the data GDP was 0.1, and in February, it went up to 0.1, positive 0.1. So this could impact, definitely it will impact the GDP USD and the FTSE sentiment on the short term. We have covered what we would have, or the events for this week. Now we can move into looking at the pairs, or the major pairs that we have selected for analysis. So this is a technical outlook and trade ideas. So when it comes to the trend of BTC USD, it remains bullish, but recent price action suggests a short-term consolidation phase. So traders, you can be cautious with the ongoing political risk and the ETF inflow volatility. On BTC USD, we have support at 75.5, followed by a deeper one at 73.3, and then the last one is 70.5. While the resistance is, the resistance is at 78.5, just around here, this area. And the major, I would say the major one right now will be 84,000. So if the momentum picks up, the scenario will be if the BTC holds above this area where you can see it has touched twice, it's almost like a double bottom. It holds around this zone. Bulls are likely to push higher towards 81,000 or to 84,000 region, but a break below 73,000 could lead to a deeper retracement with the potential of it going even lower at 70.5. But if let me say, if you're thinking of taking a long trade here, you can buy between 75.5 to 76. If the bull price action is confirmed, the take profit is at 81.5 with an estimate of making 500 to 800 points. Now let us move into this currency pair. Okay, oh yes, here. So let us move into this currency pair, euro dollar, which is behaving really, really nicely for a long trade. The trend on euro dollar is bullish. The pair continues to gain ground amid the weakening dollar and expectations of a softer US CPI reading. So a dovish Fed sentiment would support this uptrend. So a heavy resistance, a support, not a resistance, a support at 1.1010, where it has actually bounced off. and we have immediate resistance at 1.1080. It's not that far, close, but plausible. So the scenario would be if the euro remains above 1.1010, it's giving rooms for bulls to target 1.1145 in the upcoming session. So it's taking when you're taking a longer position. So when you're buying, you will buy the dip at 1.1010. So that means at this time you should be on the position already with a target at 1.1140 or 1145. 1.1140, and with an estimate gain of 120 to 140 pips. But if this happens and there's a break or a retest below 1.0950, then we might have a target at 1.08. Where's my cursor? 0890, which will give around 70 to 80 points. But the mostly scenario is actually just to buy at the dip, hold until the target. Now we move to the yellow metal that everybody likes. The trend on gold is also bullish. So gold also remains in demand due to the rising geological risk, central banks buying, and weak dollar. So the inflation data this week may trigger an increase in volatility. So gold looks strong as long as it holds above 29 over here, over 29.40 as it's been holding. Actually dipped first and it dipped the second time. Looking good. But a break above 30.10 could open a door to retest 30.50, which is very close at this point in time. However, if the CPI surprises to upside, the US dollar might rebound, which could temporarily just push the gold down just a bit. So in these two scenarios, so we're looking to buy the gold near 29.50 to 29.60, but you should have a bullish candle that appears on the support to confirm as a confirmation. And you're looking at 600 to 700 points, taking it to 30.30 with a stop loss, of course. But if we're willing to short, we need a strong bearish signal as well around 29.40 with a target of 29.05, estimate of about 300 points. So it's better to wait for the crucial data that we have also today. So let us move to S&P. S&P is a short-term neutral to bearish trend. The index is under pressure from tariffs-related uncertainties. So the recent failure to hold above 50, and the ranges are very close on this one. 50, 60 suggest a limited upside for now. So let us look at the ranges. The ranges are very, very close together, so it makes it very critical to trade S&P. So a failure to hold 49.55. Let's go to it, 49. To hold 49.55 around these areas could lead to a drop towards 49.15. But however, a bullish reversal above 50.20, as I've said, the ranges are very close, could revive an upside movement to 5100. So the likely scenarios for a short position, you can enter near 50.30 if there's a rejection or a bearish candle pattern. with a target of 49.55, which is an estimate of about 100 points. But if we considering to go long, we will only consider it if the price breaks the retest at 50.60 as a new support. The ranges are very, very, very close. So it needs somebody who is very cautious to take a position on this one, or a momentum into the market, because all the ranges for entry, either you're buying or selling, are very close. It's a very critical zone around here. And then we move to the last one, the Dark King. Oil is also bullish, but very cautious. So oil continues to gain as Middle East tension and OPEC production cuts support higher prices. However, demand concerns due to potential global slowdown may limit the upside, as we can see. So already we have a risk of push on oil, which was at 57.5. So if oil holds above 56.7, just around these areas, 56.7, then we could see a push towards 59 to 60,000, especially if the geological tensions persist. But a break below 55.4 could trigger profit taking and bring prices back to 54,000. So if you want to take, or let me say, a long position, we should be confirming around 56.8 with a target of 59.8, which is about 200 to 300 points. But if we are willing to sell, we would sell if the momentum breaks the support below 55.4, and we'll sell with the take profit to 54,000, which is about 140 to 160 points. Very decent points for whatever that is going on around the markets at this point in time. So just to wrap up everything, so this week's market landscape remains very highly reactive to global developments, with risk of sentiments dominating due to risk or rising geopolitical tensions, escalating tariffs, threats, and uncertainties around the central bank's actions. Now, let us recap. Let's start on oil because we're already here. So, oil is pushing higher with geological support, but demand side risk, which these are just highlights, may trigger short term pullback. So, we are watching 59,000 to 60,000 resistant closely. And let us move to gold. It remains bullish. It remains bullish momentum amid the safe haven demand. So the break above 3010 could accelerate. The break above 3010 could accelerate the rally, while the CPI data may cause potential or temporary reverse. Now let us go to BTC. So BTC remains volatile with 75,000 as a key support. Very nicely holding over here. Very decent one. And 80.5 as resistance inside. That's a good trade with a clear perspective. And we're moving to Euro US dollar. It shows modest bullish bias as it holds above 1.1000. But we're waiting for confirmation from the US inflation data. Lastly will be the S&P, which is facing the downward pressure due to the tariff threats. So we're watching 49.60 for support to 50.50 or 50.100 for resistance. Very closely congested areas for buying and selling. So be vigilant. Stay woke and risk aware. Use proper stop losses as we have suggested as well, and don't chase the market. Thank you, thank you all for joining the New Lean Weekly Market Outlook. If you have any question or need trading setups during this week, send us a comment or a DM, and also follow us on our social media pages. Until the next webinar, happy trading and see you next